Yeah, and the blue light is on. It was blinking there for a while, but okay, it's on. All right, let's begin. Before we begin, I just wanted to remind you one thing, and I know I don't want to sound like a commercial, but I want like a TV commercial. But I want to remind you that one of the reasons I put the training together is because I do mortgages, and I don't want you to replace your current mortgage or your current lender. If you're happy with your mortgage company, keep them. But if you need a second opinion, consider us your first choice. That's all I'm asking. Two of my loan officers are here. Her name is Joanne, and his name is Ron. And Ron, how many years in the business have you been?
Oh, well, it shows, huh?
It shows. Let me see how many white hairs do I have?
Over 18 years in the 90s with the banks. So I come from a bank-born home savings, Bank of America, and then of course 2000 with brokerages and such, and then of course joining Ronnie's team, which we're real excited. Joanne and I both are. You want to say just a little?
Yeah, just a minute.
Real quickly. You're going to find out from Joanne too, with our experience. You may wonder why we joined Ronnie. I'll tell you something. You all know how financing is. You're learning how to drive the, anybody like, well, you like football, right? Anybody know what the red zone is? What's the red zone in football? Can anybody tell me real quickly?
Last 10 yards.
That's when you are ready to, you're in what position?
To score.
To score. 40 yards, you're in scoring position, right? I'll tell you, all you're learning right now how to move the ball down the field, right? You get in scoring position, which means you have everything ready to go up front. You got your buyer, and now you've got a pre-approval. You think you are going to score. You're in scoring position. Right. You're not going to score unless you realize the defense is going to be the hardest on you in that time period. And a lot of realtors that we've worked with in our years, that's the problem they're coming across. Is that what happens when I think everything's going good and all of a sudden the pre-approval, they drops the ball, they fumble, they get hit, somebody gets injured, the file goes out the window.
And you no longer have a transaction.
And you no longer have a transition. You have realtors on you, buyers on you, sellers on you, and you work so hard to get in scoring position. So all I'm going to say is this, just in short and brief. The reason we're here, because we had an opportunity to channel our experience along with a great system, as you can see, and being able to put our clients in the best scoring position. We know we can score either by a field goal kick, by a pass, or by a run. We have options. And unless you know how to work it and how to get your team motivated to do that, the chances of scoring is going to be very hard. So we don't just pre-qualify, we test the motivation. With motivations, there's cooperation.
That's right.
So if you don't have a buyer that's motivated, be careful, be careful. You ain't going to give that ball to a halfback and then you drag him down there. You expect him to run, correct? Be careful. Pre-approvals don't mean nothing more than just saying they got looked at. We take it from there, we verify documentation, we want to make sure we not just underwrite. There's this new terminology that we now have come to learn, and not love, but learn, is auditing.
Auditing.
Regulations are as tight as they have ever been.
Yep.
Don't question it. Trust us.
Yeah.
As your lender, we have your interest in view because we are being audited like unbelievably, but that's not your job. You got this to learn. Let us take care of that. When we pre-approve, we pre-audit. So when our underwriters get it, they open up that file, we see a picture. We don't see, there's an application. We paint a story, we paint pictures, we document it. They start to go from this to, okay.
And the underwriters like you. They like you better.
I'm so excited. My first two deals that I got in with Ronnie, less than 30 days. We're going to docs, FHA conventional.
Yep.
Appraisal issues included. Adjustment to the program included. It's not meadows no more, folks. It's not a meadow. It's a jungle. It's a journey of adjustments.
Yep.
And guess what? I love it.
Wow.
I love it to death.
But most importantly, we take care of the problems before they happen.
That's the key.
That's the key.
Because if your underwriters get a bad taste for a file, guess what? I don't care how many times you try to change it. Have you ever returned your food back to a cook or a server, and you kind of worried that something did happen to it? Okay, because you kind of have a feeling that you gave it back, and you give it back, and okay. Underwriters like to get this pleasant smell, all their taste buds excited. So when they look at it open, they go, okay. Out of all this mess over here, this one I'm going to work with.
That's right.
Okay, so just keep that in mind because you're working so hard. You're here, you're spending time. Ronnie, I'll tell you, I love this guy to death because of our systems and our experience that we bring on board. He has the system and the tool but you still have to use common sense. Get in the scoring zone, get in the red zone. But all I'm going to encourage you, don't let the ball drop.
That's right.
Okay?
And Joanne, how many years do you have experience in mortgage?
30 years.
30 years. You started when you were 9, so I've been told.
I started right out of college. Instead of going for my MBA, I went for this. I say I wonder sometimes, but I hung in there with you guys.
Yeah.
Yeah, you know, I just left Bank of America, so I know what you guys have gone through. I've been the inside lender at Prudential, other Prudential offices and so forth. So I know what you need. And basically, when I was looking for where I wanted to go, because Bank of America was not it, and I can speak from knowledge on that, because you get dropped in a black hole. And I think you guys kind of know that. The other thing is the variety of programs. We're a direct lender, so we're direct lenders for Bank of America, Flagstar, GMAC. That's what you have to be. So yes, the file does not have to be by underwriting. It can go then to their particular programs. The day of the broker is dead. We all know. They're conditioning them to death is crazy.
Yep.
And if you're working with one lender that has just one product cannot service your needs.
That's right.
The other thing that I like is that we do have access. We know the 203K, which some of you guys can have a deal, and all of a sudden you got to flip it to a 203K. If you don't know, call me, I'll tell you, we'll talk about it. But of course, that's for repairs for FHA loans. We've been talking about, you've been talking about, I don't know if that's sealed yet, having an inspector go out prior on your listings to tell you what would be.
Call us if you have an REO condition or property that you are nervous about getting financing on.
Right.
If it's structured correctly, honestly, I'm going to tell you folks, my relationship with a direct person who is actually selling REOs, he's a big REO account, is accepting offers on properties that are not good, but if you structure the financing carefully, they'll tell you, yes, we can share that with you. Right. Just give us a call. We'll tell you how that's being done.
Exactly.
That's right.
And that's the name of the game right now. Our approvals are some of the best. I know your packages have to be good when they go in. Our pre-approval, if you haven't seen it, let us send you a sample of it. It's very good. It tells the debt ratio. It tells what they need to close. We give a copy of the DU, and a lot of agents don't run a DU. They don't do a pre-approval. Some don't run a DU. We run an actual DU, which is the automated underwriter used by Fannie Mae, Freddie Mac. You know, we need that. It shows the client has been underwritten. And we don't just take the information verbally. We're taking a complete package on your pre-qual.
And verify everything.
And verify everything.
Yeah.
You can say that enough. You don't want to get to closing and have it drop between the cracks.
That's right.
That's where we are.
And one other thing that a lot of people don't realize also regarding appraisals, we have our own team of appraisals. We have them on rotation to abide to HPCC law, but we have our own appraisers, and those appraisers are my appraisers for years and years and years. And if there's something that needs to be done, I get a fast response within an hour or so sometimes. I tell them, I need this because we need to move to docs, and we'll get them right away. Sometimes when you're dealing with appraisers, you don't even know. It is almost impossible to get things done. But that's enough of that. Thank you very much for guys for coming. And give them a round of applause, Ron and Joanne. Yeah, their information is going to be also provided in the presentation. So if you have any questions, you can talk to them. Okay, we quickly go now.
I gotta get out.
Ron, there's some more there. We quickly go.
Thank you.
That's you? Yes, that's me. It doesn't look like you.
Just get a hold of Ronnie also. Give you.
Sorry.
I sit right next to Ronnie, so I can.
Yes.
And I'm Ronnie.
And Ronnie speaks Spanish. I know.
Yeah.
I'm very good at it.
And I'm gonna stick our neck out and say, if any of you folks want to come and visit us, please do. Please do. Okay. Feel comfortable with who you're going to work with. Coffee's free. But enjoy.
All right. Okay, so why so many people after they got accepted for loan modification they fail to continue? Well, doesn't make financial sense. Now let me tell you something, guys. You may be wondering this. What I said before, I'm going to repeat it again. I don't do loan modifications. I don't actually prospect for loan modifications. I prospect for loan modification appointments, and I'm going to explain you the reason why. What happened is that we started prospecting for short sales, and you go to somebody's door and you say, hey, you're in notice of default, do you want to short sell your home? And the answer you get is no. Basically, people don't like you because you're trying to take their home away, right? That's the way they view you, right? So what we started doing is we started prospecting for loan modifications. You know, my wife and my team will go out there. I have Mike and I have Gloria and I have everybody else go out there. And what they do is they come out to the table and I said, have you heard about the new HAMP loan modification program, or have you heard about the new Obama loan modification program, or whatever you want to call it? And people will say probably not. Then we will say, well, you know what, you may qualify to reduce your payments. Why don't we set up an appointment in the office so we can review your documentation? When we make that appointment, we give them a list of the documents they need to bring. That is important. I already told you that, right? People will come to the appointment in my office, and we'll sit down and we'll review the numbers based on the calculator that I created, which you're going to get a copy of. And in most cases, if the people are upside down, and for one of the requirements for the people that we door knock actually, or my team door knocks, is that the people have to be upside down more than $100,000. If the people is not upside down more than $100,000, maybe a loan modification will be a benefit for them, but I don't want to talk to them. I can't help everybody, unfortunately, and there's a lot of people out there that need help, so I need to concentrate my efforts on the things that work for us as well. So that's what we do. Now, does it make financial sense? We're going to go into that right now. We use a system called Foreclosure Radar. You can get an account with them. It's www.foreclosureradar.com. I'll give you the link at the end of the presentation. Foreclosure Radar is $44.95 a month. If you don't have the $44.95, I always say get 2 or 3 or 5 of you together and get it for your own. If you cannot get it for you, ask your broker in your office to get it for you. In our office, we provide it for free. We have a computer that has the website address and the username and password already in there. If your broker doesn't want to provide it for you, come to my office. You're always free to come. Like I said, in my office, the doors are always open on the way in and on the way out. So, Foreclosure Radar. Now, we're going to check out a couple of examples here before we go into the calculator. Now, I have 2 types of examples right now. Example number 1, it says the person is not upside down by too much. And then the second example is the person is really upside down. So we're going to go into those 2 examples, and I'm going to need 3 people to help me, or 4 people to help me. So you, sir, you're going to be the first one to help me.
Okay.
I'm going to open this sheet here from Foreclosure Radar. This is actually from last month. Unfortunately, I didn't have time to go in and get a new one, but it nonetheless is the same thing. So this one here, if you look at the sheet for Foreclosure Radar, it tells me that this person has 1 trustee open right now for $366,525, and a notice of default for $19,452, which is what they're in default right now. And they don't have any second. Now, sir, can you please write down in your notepad, first loan amount, $366,525.
Got it.
Okay, number 1. Number 2, notice of default, or the amount that they're behind, $19,452. And the year that it was issued, the loan was issued in 2008. So 2008, 9, 10, 11, that's 3 years. So they have 3 years, so 27 years left. 27 years left in their mortgage. Now they owe 366, and the market value of the property is 352,514. Can you please write that down? 352,514. I'm gonna need another person to help me with the second example. All right, and the second would be the following, ma'am. Loan amount on the first trustee is $300,000. Okay. Amount behind on the payment, $35,325. Loan amount on the second, $24,071. And the value is $308,502. All right. Let's jump to the next one. Oh, I'm sorry, and the years. Forgot about the years. And the year that it was issued was 2007. 2007 for the first, 2008 for the second. All right, let's go to the next example. Okay, this person has a first trustee of $588,000. $588,000. They're behind on the payment, $56,529. $56,529. And the second trustee is $110,250. $110,250. The loans were issued in 2006. That was probably an 80-20. And the loan and the market value for the property right now is $389,888. $389,888. Now the last example that I have. The first loan amount is $480,000. Anybody's going to write it down? $480,000 in the first loan amount. They're behind on the payment, $27,078. $27,078. The loan amount on the second is $120,000. $120,000. The loan were issued in 2006. And then the market value for the property is $350,728. $350,728. $350,728. I am going to open the calculator. Now let me give you a little bit of a background regarding the calculator. Pardon?
The year the loan was taken out?
2008. Okay, let me give you a little background on the calculator that I created, that I developed. I'm really handy when it comes to Excel. I've been using Excel for many, many years. I remember the first class that I got in Excel was when it was called, let me see, it was called Lotus 123. Yeah. Remember Lotus 123? That was the first class that I took. The second class, it was Quattro Pro.
Maybe visit calc.
Yeah, exactly. So anyways, I've been using Excel for a little while. Through the process of doing loan modifications and knowing, as I know, the guidelines for loan modifications when it comes to ratios and when it comes to interest rates and amortizations and all that, I started creating several different calculators that in order to show people whether or not it would make sense for them to keep the home or not. One day it occurred to me, I said, well, why don't I put all the calculators together in one spreadsheet, because I had different spreadsheets. And I said, why don't I put all the calculators together in one spreadsheet? And I found it to be actually more difficult than I expected, because there's so many different calculations that go involved in this. Now, what you see right now in front of you is a final product. It's the final product, and it looks very simple. As a matter of fact, it's so easy to use that some people say to me, oh my God, this is so easy. You've probably done it over the weekend. It actually took me 8 months of work to create all these calculators. I have 9 different charts attached to this calculator. Coming from here, I have 1, 2, 3, 4, 5, 6, 7, 8. I have 8 different spreadsheets that I actually had to create in order to get the results that I needed into this calculator. Now, let me explain you how it works. It's very, very simple. Now remember, the HAMP loan modification. This is what the HAMP loan modification states. The goal, the objective of the program is to reduce your ratio, your housing ratio, to less than 31% of your gross income, right? And they do that by lowering your interest rate and increasing the amount of years on your mortgage. So they lower your interest rate to adjustable rate mortgage interest rate on the market right now, which is 3.18% or 3.25% for most times, but they can go as low as 2%. Do we agree on that? They can go as low percent, but they don't have to, right? Right. Okay, that's the first thing. It's a 40-year product. That means that they're going to extend the years for 40 years. So this is what we're going to do. We are going to start entering data, and the data that you need to enter is the red fields. And red field number 1 is loan amount number 1, interest rate and amount remaining on the loan, the years remaining on the loan. Loan amount number 2, interest rate on the 2nd, years remaining on the loan. And then how many months behind on the payment, what is the current market value of the property, and if they have any association HOA fees. That's what you need to fill in. You can also change that. It's defaulted for the current interest rate for adjustable rate mortgage to 3.18% for 5 years and 5% for 35 years. But you can change these amounts if you want to do that as well. How does the HAMP work? Very simply put, HAMP is an adjustable rate program, an adjustable rate mortgage program. But it doesn't adjust as scary as you may think. You may think, well, it's an adjustable rate mortgage. It's going to adjust, I don't know when or I don't know for how much. That's not the case. They will tell you, as soon as you get approved for the loan modification, they will tell you how and when it's going to adjust. So what we see on the market more than anything is they give you 3 years at a teaser rate, that's what I call it, at a teaser rate of 3.18%. From year number 3 to year number 4, it goes 1% higher to 4.18%. And then from year number 4 to year number 5, it goes 1% higher to 5.18%. And then it remains fixed for the remainder of the amortization period, which is 35 years. So you have, for the most part, you have 3 adjustment periods. The first adjustment period at 3.125, the second adjustment period at 4.18, and then the third adjustment period at 5.18. That is what is on the market right now. Okay, now those numbers may change a little bit, yes, but that's what's on the market right now. So for the purpose of the example of the exercise in the calculator, I am not concerned about the second adjustment, because what I want to know is how much is going to decrease right now, and once it goes up, you know, for the remaining 35 years, how much is it going to be? That's what I'm concerned about. So I only have 2 adjustment periods in here.
Ron, what's the loan amount, the maximum loan amount for HAMP?
$729,750, and we're going to cover that too. Like I said, reserve your questions because we're going to go over all of this. All right, Current loan amount. So I'm going to take you, sir. The first loan amount is?
$366,525.
Okay. For the purpose of the example, because I don't know the interest rates, we're going to utilize 6% and 7.5%, which is very customary for that time period when they got the loan. So 6% and 7.5%. So 6% interest rate. And how many years they have in the mortgage?
They have 3 years in,
27 to go. Okay, so we have to put the years remaining. All of the data is important because the calculations will not work correctly unless you put the right information there. Okay, so 27 years. It says years remaining on the loan. That doesn't mean that you're going to put 3 because they got in 3. No, years remaining is 27. And I have a reason for that because there's another calculator that works based on that number. Okay, they don't have a second on this one, right? And the market value?
The market value is $352,514.
514. Okay, so based on that information, this is what I can tell you about this consumer. Right now, they're upside down $14,000. They're not upside down that much. Okay, so that I want to get it out of the way here. They're not upside down that much. Now, what their current payment looks like. This is a chart that I use for comparison. Now, this here is what their current payment would be if they have a interest-only loan, $2,252. And this one here is if they had a fully amortized payment. That means that based on $366,525 at 6% interest rate for 27 years, this is what their interest-only payment is, including property taxes and insurance, because the loan modification will be impounded. There's no way that you cannot get it impounded. It has to be impounded. That means that they have to pay property taxes and insurance in their monthly payment. So this is what the payment is on an interest-only loan, and this is what their payment is fully amortized. Now, the number I always say to the consumer, your payment is between $2,200 and $2,600. Is that correct? And the answer for the most part is yes. Now, you may find some consumers in which their payment is lower than $2,600 and $2,200. And the reason why is because their loan has not recast yet, and they still have the teaser rate of 1%, 2%, 3%. I hope you understand that, okay? So maybe their payment is lower than what it shows here, and that's okay. All right, I just use this as an example. I'm not concerned what their payment is because I know I can see on the papers what their payment is. What I'm concerned about is how much their payment is going to go down to, all right? So based on an interest rate of 3.18% for 5 years at $366,525, your payment, your approximate payment based on principal and interest, property taxes and insurance could be as low as $1,758. And I always say could be as low as because that reflects that if this interest rate is higher, their payment, of course, is going to be higher. So it could be as low as that, $1,758. If your current payment is $2,617 fully amortized, that represents a savings of $858 a month. So far, so good. I like that, right? Now, after 5 years, after what I call the teaser period, your payment will go up to 5% and remain for 5% for the remainder 35 years. Your payment will go up to $2,068.30. That's an increase of about $300, and that's a decrease from your current payment of $549. Does the loan modification in this case make sense? Absolutely. Absolutely. I would do that loan modification in a heartbeat if it was me, all right? Because it's going to decrease my payment. Now, some of you may be thinking, and I know what you're thinking, some of you may be thinking, well, this is a 40-year product. Aren't they going to end up paying more interest at the end of the term? Oh, absolutely. The banks are not stupid. You know, actually, banks don't hire stupid analysts. Do you know that? The banks don't hire stupid analysts. You actually have to be pretty smart with numbers to make sure to be hired by a bank. The banks came over and they say to the analysts, well, we need something in which we can help consumers remain in their house, lowering their payments, but at the same time, we don't lose any money. And they came up with a 40-year product, and this product right here. Because on a 40-year product, this is what I can tell you. On a $300,000 on a $300,000 mortgage at a 30% interest rate, a 30-year amortization period at a fixed interest rate, your payment for principal and interest is divided about 85-15. So 85% is interest and 15% is principal, right? So let's say on $300,000, you're looking at $2,000. $1,750 go to the interest, and $250 go to the principal. On a 40-year product, you guess how much goes to the principal every month? Like $46. I mean, it's nothing. You're paying, at the end of the term, of the 40-year term, you're actually paying like an extra $300,000 or $400,000, you know, just for having a 40-year mortgage. It is not a good deal. Would it make people remain in their home if their payment gets adjusted to $1,758? Absolutely. Absolutely will. Will they end up paying more money in the long term? Yes, absolutely they will. But that's just that. Now, the other thing is, here's the second part of it. Now, so I explained to them that this is what their payment is going to decrease. Remember what I said at the beginning of the conversation. I said, I don't prospect for loan modifications. I prospect for loan modification appointments. We turn around 85% of the people that we sit in for a loan modification. If the loan modification doesn't make financial sense for them, we turn around those people and convert them into short sales. And I'm going to explain you the reason why. First of all, we have 4 levels to create that. The first level is the following. Sometimes the loan modification is not going to save them money. Believe it or not. As a matter of fact, I have consumers saying to me, I just got offered a loan modification by Bank of America and my payment is going to go up. How stupid that is, right? Well, if you had a teaser rate at a 1%, 2% interest rate, and your payment is, let's say at 1%, your payment would be about, let's see, we can actually calculate it here at 1% or 2%. Let's say 2%. Actually 1%. No, 1.5%. So it makes a little bit sense. Your payment fully amortized is $1,684. At a 1.5%, your payment is $1,684. When you do the loan modification, your payment is $1,758. So your payment is going to go up. So some people complain to me and they say, how is this? I applied for a loan modification and my payment is actually going to go up. Yes, it's going to go up because the interest rate that you have is actually lower than what they're offering right now. That is the reason why, right? So let me go back and change that back. 1 second. 6% there. So on the first screen, I asked the person, if the loan modification is not going to save them money, I asked the question, does it make financial sense for you to keep the home? Now, mind you, I never tell people to short sell their properties. Not flat out, because that's giving legal advice. I don't tell people you should short sell the property. I ask the question, does it make sense for you to keep this home? And that's the basis of my question. I repeat it over and over again. Does it make sense for you to keep this home? Does it make financial sense for you to keep your home? Now, the second part of it is the pre-qual calculator. Now, you know that your mortgage payment should not exceed 31% of your gross income. For that reason, I created a reverse calculator that tells you whether or not somebody will qualify for the loan modification or not. In the first 5 minutes, you meet with them. As a matter of fact, there is so many attorneys, paralegals, loan modification specialists out there that have no idea whether or not the person is going to qualify for the loan modification because they don't understand the rules and they don't have this tool that now you have, okay? We go into the pre-qual calculator. And the pre-qual calculator tells you that in order to qualify for this loan modification, $366,525 at 3 1/8% for 5 years. This is your total payment. The minimum income requirement is $5,672. And remember, I said income is 95% of the approval on the loan modification, or 90% of the approval on the loan modification. Loan modification approval is 90% based on income. If they don't make enough income to qualify, they will not qualify. It's just like a refinance. It's just like purchasing a home. So your minimum requirement income is $5,672. Before I go into the screen, I usually ask people after I go into the screen before, and I noticed that a lot of people started lying to me. So before I go into the screen, I ask them, how much do you and your spouse make? Or how much income do you make? And somebody will say to me, I make $5,000. And I would write it down on a piece of paper, big numbers. Okay, you make $5,000. This is all the income you got, right? When I go to the next screen, I said, in order to qualify for the loan modification, you need to make $5,672. So by definition, if you only make $5,000, and I'm going to write it down here, $5,000, you don't qualify. I mean, it tells you right there. You don't even have to think about it. You can just show them, basically. They say, well, maybe we can have our son help us with some money. Okay, how much your son makes? Well, $700. Okay, so I'm going to change this to $5,700, so now you qualify. What is your car payment? Well, I have 2 cars, the Mercedes-Benz and the BMW. And how much do you pay for your car? $750. $750. You just no longer qualify anymore. because we have to go through the ratios. And the housing plus debt cannot exceed 43%. The ratios for loan modification is 31-43. If your expenses exceed your housing 31% and your housing plus expenses 43%, you no longer qualify. And that's just that. Some people disqualify because they don't make enough income for the housing, and some people that make enough income for the housing disqualify because they don't make enough income for the expenses.